So in previous lessons, you had an in-depth look at the relationship between hotels and OTAs, and you learned that this connection was not two-way, and you helped me save some money. You also learned that the technology causes unreported commission costs, and what this does is skews the hotel's understanding of customer acquisition costs. Now, what I want to do here is really just tie everything together. It's starting from the financial management cycle all the way to distribution channels, and then we can perfectly segue into our last theme of this program, revenue management. So let's review the key concepts here that you learned. So starting at the financial management cycle, your role was to help convert raw accounting data into useful accounting information. And on the lesson with market segments, you took this further by distinguishing revenue earned not just by each day, but by each market segment. And I kept repeating your benefit to the company, the result of your impact, the R in the star format for interviews. And that was to help the hotel better understand its financial performance. And so in this lesson, you're really going to see this come to life, because in hotels, we have a term for this. There's actually a financial metric to illustrate this financial performance we've been talking about throughout this whole program. And it's an industry-wide used ratio that's known as RevPAR. And again, it's a metric that measures a hotel's revenue performance. So in the beginning of this program, the lesson on market segments, I briefly touched on two key revenue management concepts: occupancy and ADR. So I gave the examples of two really bad revenue management strategies. So on one hand, we can focus on increasing our occupancy. So to do this, we'll make a ridiculously low rate, $5 a night. I assure you, if I price my rooms at $5 a night, I will absolutely sell out. My parking lot is always going to be full. In fact, if I kept it for $5 a night for a whole year, I'm going to sell out every single day of that year with occupancy as high as 100%. I'll probably be known as that one hotel that sells its rooms for $5 a night. And let me tell you, not even the best hotel in the world can beat this number. But if you think about it, what's my ADR ever going to be for that year? It's going to be $5, right? Now, with the other strategy, my ADR can be 60 times higher. I can price my rooms at $300 a night, and this sounds great, I can say, hey man, my ADR is $300. But do you think my parking lot will ever be full? No. In fact, my parking lot will be the opposite of full. It's going to always be empty, with my occupancy being very low. So the point I'm trying to make here is that both occupancy and ADR are important metrics for a hotel's performance, but when they're analyzed separately, the numbers are absolutely useless. So if you're Trump's revenue manager and you give him just the occupancy reports of his hotel and nothing else, or if you just give him the ADR reports and nothing else, this is what his face is going to look like. So how do we solve this problem? Well, it goes back to what I was talking about earlier in the video. It's about RevPAR. And the power of RevPAR is that it takes into account both metrics, ADR and occupancy. And again, this ties back to the benefit or result of your work, of your impact. The goal is to help the hotel understand its financial performance, which is your role. So the best part of RevPAR is that it's pretty easy to calculate. All you got to do is multiply ADR with our occupancy rate. So you would take our first example when the occupancy was 100% for the whole year and multiply it by $5, which is the ADR, or you would take our occupancy of 1% and multiply it by $300. So sure, you might say an occupancy rate of 100% is good, or an ADR of $300 is good, but these RevPAR numbers reflect the true performance. And as you can see, they're pretty bad. So your role is to help me determine my true financial performance by helping me figure out what my RevPAR is. And the thing is, you already know how to do this. So another way to calculate RevPAR is revenue earned over a time period divided by number of available rooms. And if you kept up, you've already been helping me calculate my revenue earned as you create those journal entries. So the material here isn't really anything new. It's still review. It's actually a review of what you've been doing, with you calculating the revenue earned, but now we're just putting it into a metric that we can use and analyze. Now here's the interesting part. RevPAR is still not good enough. RevPAR is still not good enough because RevPAR doesn't take into account our cost. And this ties to what you learned in the next theme of the program, our distribution channels. RevPAR doesn't take into account our customer acquisition costs because it simply just goes off of revenue earned. We don't get the full picture when we think about hotels' financial performance because at the end of the day, it's not just about revenue earned, it's about profit. And profit takes cost into account. The good thing is that you also already know how to do this, right? From our recent lessons, you learn about net rates and Hotel Collect, and you understand the relationship between OTAs and the hotel, and you have a pretty good idea about how customer acquisition costs work. So not only are we going to calculate RevPAR, we're going to calculate what is known as NRevPAR, net RevPAR, and this is a revised version of RevPAR, and it's thought of by a well-known revenue management company where we take into account not only revenue earned, but also our customer acquisition costs. So the formula is room revenue minus customer acquisition costs divided by total available rooms. And just a quick thing to note here, we can even go further with another metric called GOPAR, and this takes into account all the variable costs of the hotel. So a variable cost is one that moves along with our occupancy levels. So other costs that we can incorporate here include housekeeping wages, specifically the housekeepers that actually clean the rooms, guest room supplies, utilities, etc. And this ties to my previous point where revenue really only captures half the picture. And if we take into account the incremental cost, we can get a better idea of profits. Now, for the sake of keeping the material relevant to your work, I'm only going to have you address our customer acquisition costs. So you only need to help me calculate my RevPAR and my net RevPAR, but I want you to keep in mind that there are other performance metrics out there. So to conclude, what we've done here in this video is really tie everything together, starting from what you learned with the financial management cycle all the way to the distribution channels and onto this lesson where we're putting it together to try to figure out our financial performance. And at this point, your focus was just on getting the information that we need. You helped process accounting data to get revenue earned. You helped ensure our customer acquisition costs were accurately reported and calculated. But now is when we start getting into the analytical side where we're going to spit out these metrics, and in the future lessons we're going to start looking at trends and seeing how we can use this information that you helped me collect and determine the proper revenue management strategies to help the hotel make the most money. So stay tuned for the next video where we use Excel to make this magic happen.